All right. Welcome to the Happy Hour Money Podcast, where we just sit here and talk about all things money and do a little bit of drinking beverages. I'm your co-host, Josh Bennett, along with my other co-host, Isaiah Douglass.
Yeah, good to be here. We're going to talk about a topic that apparently is not happening, but is happening. So I think that'll be a fun thing. So there's a little sneak peek for those that clicked on the episode without reading the title. So hopefully you did read the title though. So we'll buckle in, but
if not, surprise.
Yeah, surprise. We're going to talk about the dreaded R word, and which is a recession, which I don't necessarily think is a terrible thing. But Josh, how do you define a recession? Since at the moment there seems to be conflicting opinions, and does it matter whether it's defined as a recession or not?
Yeah, as of the recording of this video, or I guess audio too, in case, since we don't really know when we're going to post this yet. But basically, right now, the White House has been, and a lot of popular economists, especially, without getting into politics here, left-leaning, have been sort of trying to tweak the definition of recession, or at least the precedent of recession and kind of the conventional wisdom. So historically, I've defined it as kind of 2 consecutive quarters of declining GDP, which has also been sort of this, it's not the official definition. If you look on Investopedia, it's in the official definition on Investopedia, but it's, contracting economy is essentially a recession, but more often than not, because there's no real direct way of saying, okay, these measures equal a contracting economy. Most people have sort of gone with 2 back-to-back, or aka 6 months worth of declining gross domestic product. I mean, would you say that's a sort of fair?
Yeah, I would call what is happening right now a term that is called gaslighting, which is basically people just straight up lying to you, because we 100% are in a recession, and a recession is 2 quarters of GDP that is negative. And to me, it's nothing to run from. It's okay. It happens. It's cool. Like, let the adults then make decisions. Don't try to sugarcoat it. Like, just say, hey, this is where we're at. Things might suck for a bit, but we'll get through it and it'll be fine. And I think that, to me, is the thing that's most frustrating, is people just won't own up and be realistic and honest and open and say, yeah, we're in a recession. This is what's going on. And this is how we can work through things and try to help people, versus trying to lie to them and just not be truthful and honest. And to me, that's the thing that's the most frustrating. But yeah, so whether it is or not, I mean, people are struggling and things are going to be hard and maybe get harder, because it seems like people don't want to actually address the underlying issues. So
yeah, and I think some of the politicians forget, and it's easy, in politics these days, it's very short-term thinking, goldfish memories of, hey, what have you done for me lately? And so right now, all people are thinking about is, Biden could have done 1,000 other things well, but all people are thinking about is inflation and recession. And that's coming into midterms and coming into elections where the Democrats want to stay in power. Yeah. And the way to do that is to basically try and change people's thinking of, hey, this is not a recession, and hey, inflation's Russia's problem. Let's create this other enemy. And, it's frankly political genius. But
Squirrel.
Yeah, it's political genius. But at the same time, if we look back through history, the politicians that are the ones that we still remember today are the ones that basically, part of my, coarse terms here, but, grabbed bad times by the balls and took controls of it. Look at FDR, brought us out of the Great Depression by making very, very hard decisions. But also took us through World War II, making very hard decisions, wasn't always the most politically in favor, but we still remember him to this day as one of the best presidents we ever had, right? And look at Winston Churchill, or regardless of the country, the ones that we, actually for inflation purposes, Paul Volcker's one right now, he was hated at the time because he was so strict on his monetary policy to fight inflation that it pissed so many people off, but it worked. And then people now love him in retrospect because he was willing to make those tough decisions and, bring us out of hard times.
Yeah. So for those listening, the idea of the Volcker, so he was a Fed chair, and he raised interest rates to curb inflation, did it very aggressively, and basically, move things into some really difficult times. But then, on the other side of that, it was much better. So that's the quick TLDR on Volcker, but
yeah, you basically bent the economy to the point of breaking.
Yeah, which is what they're trying to do now. Biggest difference is the debt load that the federal government and a lot of companies have is vastly different than it was when Volcker was in his chair. So it's not going to be like a replay of that. And I think those that think it will end up being the exact same outcome might be surprised with what happens. So we don't know, right? Like we don't have the crystal ball. It's broken. It's a little cloudy, right? But we have a lot of debt, and to try to raise interest rates on that stuff is going to be very, very, very challenging, because at the moment it's like trying to suck the oxygen out of the room and then come back in and revive the patient. So let's strangle them and let's come in and bring oxygen. Like that's what we're trying to do right now, what they're trying to balance. So, Jay Powell, who is the chair of the Federal Reserve, like he's tasked with, quashing inflation, right? So the idea is we need to see CPI, which is the consumer price index, down before they can kind of cut rates or stop tightening and raising interest rates into that. So we'll see, because some of the stuff structurally with inflation has been all around supply chain issues, which go back to kind of shutting everything down and then restarting. And so you can kind of pick and look at all kind of nuanced stuff, but there's a lot of issues where if Europe doesn't have the energy that it needs to create stuff, and we have a global supply chain, and all of a sudden this one part in this massive operation can't be created because in Poland they can't run their facility because they have no way to heat it or no way to run their machines, all of a sudden everything breaks down. That is going to be inflationary. And that could be recessionary as well, where all of a sudden people are getting laid off because they just can't build stuff. And so like you can certainly, snowball this into this horrible thing. But I think the idea is, okay, so if we're in a recession, how do you think about it? What are the right kind of tactics? How do you think through these kind of challenging times? I think that's ultimately what we want to try to get through and just share ideas and thoughts. And again, we don't know for sure exactly what and how this plays out. So again, going back to what we've talked about before, there's gonna be a lot of gray area where you're kind of guessing and trying to say, okay, how can I minimize regret by making these decisions?
Yeah, absolutely. And I think the first part here, and we kind of alluded to this, but is, sort of changing your mindset on a recession, so most people look at a recession as a very bad thing, which it can be for a lot of people, and it can be very painful, but if you go into it with the mindset for opportunity, well, recessions are where massive wealth is built. And I think that's something that people often overlook. But, there's a story I tell all the time from about the Kennedy family, JFK. Basically, their grandparents and stuff were always like, they were a decently well-off family, but the majority of their wealth was created during the Great Depression by basically, I think it was JFK's grandfather, basically, ahead of the 1929 crash, got scared out of the speculative bubble because basically a shoeshine boy started telling him what stocks to buy. And he was like, okay, if it's disseminated to this, something's wrong, something's broken. He sold everything, went to cash, and then basically when things crashed, they bought back up during the recession, or well, at that point in the depression. And next thing you know, on the other side of that, they're one of the wealthiest families in history, and one of the most powerful families in history. There's no reason this can't be anybody. If you look for the right opportunities, which there are opportunities, I think we should be open to a recession, because economies are meant to basically boom and bust, and that's healthy. It basically, kind of like you're mentioning on the massive debt loads. Well, the way I sort of look at it is, okay, well, if we, increase interest rates too high, or the companies that over leveraged break, that's survival of the fittest. And, that's going to open room for innovation and for companies that are going to be doing it safer and better to come in. But yeah, what are your thoughts?
I agree. Like, companies that do dumb things should be punished and go out of business, and people should, get wrecked. But that hasn't historically been the way that it's worked, because it's been kind of this idea of the profits during the good times are mine, and then we socialize the losses and it's spread across everyone else, where there's bailouts or stimulus or different things where some people that are in positions of authority or whatever, right, running publicly traded companies or other things, like they are the ones that can get bailouts. But our favorite Cuban sandwich shop guy, right?
Yeah.
Like, he closes because he can't afford to keep, paying or finding people to work. And so he is punished for it. He sees everything go away. And then you have the American Airlines, like, they'll be fine. Their executive teams are okay. they can make bad decisions and it's fine because, they are all of a sudden, bailed out from it. So I agree. Like the idea of the recession is that it should kind of cleanse things out because we do live in a credit-based system, which basically just means it's running on debt. And so when you all of a sudden say, hey, we're going to not issue and allow debt and credit to be created in flow, and you constrict that, the economy is going to all of a sudden say, oop, hiccups, burps, like we don't feel good, something's going on, get sick. But the challenge is then, it seems like certain people will be disproportionately impacted by that. And a lot of times it is smaller business owners because then they can't get the funding to keep going. Even though their business might be great, they can't go to their local bank and get, the loan or the line of credit that's going to keep them going at times, or things get frozen versus those kind of bailouts typically don't come to the smaller businesses. So that's the challenge. Maybe it changes. And again, I think there's been some interesting conversations around just politicians in general and kind of the age of where people are, and does this adjust over time where as new leadership comes into power, do we see a change of how we've done things in the past? Because I think this idea of the haves and have-nots, like the system that we're in is going to continue to create that wider and wider gap. And Jeff Booth in his book, The Price of Tomorrow, and he's talked about this on different podcasts, which is an excellent book. It talks about why deflation is the key to an abundant future. But he has talked about you can never build walls high enough, right? You never will. Like it will get so bad where you might have all the money in the world, but you need to have some way and some semblance where everyone feels like they have a fighting chance. And the United States has been the greatest country in the world because we've given that historically. And so I think if we preserve that and we go through a recession, to your point, and there are opportunities, a lot of people have created a lot of amazing startups through recessions too. Like if you go back to 2008, a lot of really cool, innovative companies that are now, household names were started during that period. Hey, I got let go. Hey, I got let up. Okay, now I'm going to focus on what it is that I actually want to build. And if you're in a spot where you're like, hey, I have, a cash cushion, I have an emergency fund, I have, some things that I can work through. I can find employment somewhere. It's not maybe as glorious as what it was before. My comp isn't the same, but you can make adjustments. There can be some really good things that come out of it. And it gets back to kind of that scrappy mentality of kind of the idea of like, we're going to build something that solves issues. And so that to me is the part that is exciting. That is the thing that people should look towards as that kind of silver lining. But again, I don't want to be the person that's gaslighting as well. Like it can suck and probably will suck as well, because when you lose your job, like that's never a good thing. And I think we're starting to see that happening more and more. It was from Dylan LeClaire, who he had a really good post, and I'm going to get it also in the show notes. But it's basically the housing market and unemployment. It was tracking the same thing. And if you look at the change in the housing market index going back to kind of 2008, what you saw was the housing market index as it spiked, unemployment lagged and followed that. And so what we've seen is the largest 2-month drop of medium single family home prices ever. Even Great Financial Crisis, like we saw a massive move. And then the labor market is still really, really tight. So our unemployment is still sub 4%. And so does that follow where, you saw unemployment close to 10% going back to kind of the 2008 Great Financial Crisis? We haven't seen that yet. So it'll be interesting to track and see what unemployment does here over the next, call it 6 to 9 months and what happens. But when you start hearing those bigger layoffs from big companies, like that does impact businesses that are kind of built around them as well, that service them a lot of times.
Yeah, and I do think the unemployment number these days is sort of misleading, which I'm sure you would agree with. But I don't think the unemployment numbers are going to drop as significantly as they did during COVID. And part of the reason why is what that number doesn't necessarily entail is the people that just flat out dropped out of the workforce.
Yep.
So you had a massive number of people that just dropped out of the workforce during COVID and just never re-entered. So the actual pool of labor is lower. So therefore, the numbers, even though it's a low percentage, the numbers of jobs compared to available workers is just out of balance compared to what it normally is. And so I don't think we're necessarily going to see the huge spike in changes of labor like we normally would. And I think we're still going to see massive layoffs and things. I mean, we're already seeing that, especially in, I think, certain industries because companies over leveraged. Like I won't name names here.
Name. No, I was kidding.
But I was talking to a client about a potential job prospect, and he had me look at his current employer, which is a publicly traded company, and I looked at the profit and loss statement, and I was like, yeah, there's going to be massive layoffs at this company because even when it's a publicly traded company, they basically have six months of burn rate, unless they make some major changes quickly. And it was just due to overspending, over leverage. They thought the music was going to keep going, and then lo and behold, a week later they announced layoffs. So I think we're still going to see that in a lot of sectors, especially like tech and some others that were just highly leveraged during sort of the boom we've seen over the past 10 years. But again, I think there's still a lot of opportunity even for those that are laid off, whether it's getting other positions, making career changes, things like that. But what are some opportunities that you're seeing? Like, so say I'm an average Joe and either I'm laid off or, I'm just working my job trying to make it through the recession. Like, what are the opportunities out there for me to, sort of capitalize on this type of environment?
It depends on your skill set and where you want to be and if you're location flexible, right? So, I mean, if you're in a really expensive area, maybe you think about relocating somewhere that's more affordable. I think that is one that easy because of the ability to kind of work from anywhere. I think having location flexibility is big, and that doesn't always work. If you have kids and have family, like, you're not leaving this area, right? Like, there's certain things where it's going to restrict you moving. But Luke Groman was on, I think it was Tales from the Crypt with Marty Bennett, and he was talking about the petroleum engineers that we graduated in the United States was 400 last year. And then there was like 2,000 people that just were drafted for the MLB draft, just to give you an idea. And there is a massive amount of labor shortage and issues in finding workers in energy production, oil and gas, exploration, all those different things in the United States where, yeah, it's hard work and it has historically been boom and bust, but there is just a complete shortage of finding like help. Now there's some learning curves, some training, but if people were like, shoot, I enjoy, working with my hands, I want to get dirty and I'm fine to go move to Cushing, Oklahoma or something. Yeah, you can go make really good 6 figures money, I think, for the foreseeable future, because energy independence, energy production is going to be something that we greatly need because we don't want to turn into Europe where we don't have the energy infrastructure built out. And we haven't invested in it historically over the last 10 years because everything's been ESG, which we could have a whole episode, and we probably will, about ESG being complete and utter BS, right? And there's a lot of issues with trying to think through having all energy sources being renewables. But I think that's one idea. Another could be, thinking about like, hey, if you have a really creative idea for trying to start something up, like how can you get, that MVP or minimum viable product up and running? And maybe you need to go and just kind of side hustle, drive Lyft, Ubers, do Shipt, do whatever to try to just bring in some money to give yourself runway to do that, I think is interesting. I think a lot of businesses are still going to look at going to like Fiverr or Upwork. Instead of hiring someone, maybe they're going to outsource it and just say, hey, I can pay this person through that. So if you're talented and you can do graphic design, or you can do, podcast editing, or you can do whatever, there are ways to find and manufacture money from that standpoint. And so I think it's all going to be dependent on their skill set, but there's a lot of ways in kind of the gig economy to where if there are layoffs and maybe everything was done more in-house, and now all of a sudden it's like, hey, we're going to just kind of outsource this, but we don't have to pay benefits, we don't have to pay all the taxes and all that other stuff, that will be beneficial for a lot of individuals. And that could be a way to kind of continue to keep your skills sharp and build out kind of your work kind of portfolio from that standpoint. So, I don't know.
Yeah.
And I think there's a lot of baby boomers that might not want to go through a recession. So going back to, your favorite topic of figuring out a way to go get financing, which is tricky in a recession. So I think that is obviously the caveat here. But if you have someone that is willing to say, hey, I don't want to go through this again. I've been through this before. I'm tired. I'm getting towards the end. Work with them. Maybe you can buy an installment sale. Maybe you can give them, from revenue to buy this business and keep it running and bring some fresh blood where they know they have a transition plan. They can be out, but they can still get paid. And maybe you can do that all through without doing traditional financing. Maybe they'll hold a seller note or do something creative. But yeah, go find that. I've talked with clients, like there's a tool rental business that was like super profitable and unsexy, and guy doesn't really want to run it anymore because he's older. And it's like, oh, this could be interesting as an acquisition where you could go get financing and you don't need super high skilled labor to run that. You have the warehouse, you have the space, you have, some logistical things, and maybe you can upgrade some tech and do some things a little bit better, but it's a pretty profitable business. And, there are lots of those out there that are unglamorous, that are not going to be the cover of a magazine or, all over Instagram about how cool your job is, but you can go cash some serious checks. And I think that's interesting.
Yeah, and just to kind of go through an example of this, like one, buying, like, me, I love this topic, but like buying recession-proof businesses, yeah, is unsexy and most millennials don't want to do it. But there's like, I forget the exact statistic, but there's like 18 million small businesses going for sale like a year, which is just insane number. Especially when you look at like the total labor force. So the number of like businesses that are going for sale to transition, there's just not the number of millennials that want to run the business. Everyone wants to be the next Elon Musk, which granted, I'll kind of go on, agree with you on the startup, side hustle thing. I think is a super great way to go about it. I think everyone has a skill set that they should take advantage of, especially during hard times. And I think even during hard times, people will always pay for value if you can be valuable to individuals out there. And there's lots of ways to do that. But with buying a business, like let's say, let's call it a landscaping company or an HVAC company or plumbing company. None of them are sexy. Unless you're into that sort of thing. But,
yeah.
But like, people, even in recessions, need to get their lawns mowed. Businesses need to get their lawns mowed. Pipes burst, whether we want them to or not during recessions. And like I've looked at businesses just to kind of go through the numbers, like where, say a landscaping business was for sale for $1.2 million, which sounds like a ton of money, right? But the revenues of this business were like $3 million, and the cash flow to the owner was like $800,000 a year. So for $1.2 million, you're buying $800,000 worth of cash flow. And where the numbers get even more interesting is you can get an SBA loan for these where you're putting basically 90% leverage, which the SBA tends to be one of the few lenders that still work during a recession because banks are more willing to give SBA loans because they're 75% guaranteed by the government. And if the cash flow is there, you can still qualify. And seller financing is something you can also do where, you can basically split the down payment with the seller and do 5% you, 5%. So you can basically buy a business for 95%, other people's money. So of that 1.2 million, let's say your down payment was $60,000, which still may be a lot, but you can also go get a partner or someone that has that money and wants to be, say, a 10% owner and, raised from friends and family, and then there you go. But let's say you go buy that 95% or go buy that business for 1.2 million. $100,000 of that is going to be debt service. You're still making $700,000 a year. You pay yourself back in basically 2 months, or pay your family and friends back in 2 months. So that's just a really powerful way to get cash flow, or like say you're laid off and need employment. Well, that's something you could easily do. And to your point, that's within a traditional SBA loan, but during a recession, there's going to be a lot of people that are just tired and trying to get out that may not want to go through the hassle of waiting for you to get financing, and it may just say, hey, come on board. Just give me your down payment and I'll finance the rest over 5-10 years. And then, you have that transition plan. To me, I think this is the best way that anyone can grow wealth. But I think especially during a recession, these things are going to be trading for essentially pennies on the dollar because people are going to be tired. They're going to want out, and they're just not going to do it.
Where do you like to look for businesses? I was just pulling this up as we were chatting. Like the biz buy sell is obviously one that's easy to see, but are there other resources that are easier to find businesses, or how should someone go about looking for them?
The easiest way is online through like the online marketplaces. Like Biz Buy Sell is a big one. There's a bunch of others that are kind of similar in nature, similar to like Zillow and Redfin of real estate. It's kind of the same idea here. Typically, they're not going to be the best deals by the time they hit Biz Buy Sell. They could still be very decent deals on there, and I've seen some decent deals on there. But typically, what I do is I stroll through something like Biz Buy Sell, look for businesses that are kind of in the wheelhouse of what I'd be interested in. And then the broker is always listed as part of that. And so I then click on the broker's website, see what other businesses are for sale through that broker, try to reach out to the broker, have a conversation. And more often than not, you can basically build a relationship with that broker and say, hey, here's exactly what I want. I want to buy a landscaping company at this multiple, say I have $100,000 down payment, so I can basically afford, up to $1 million with my own financing or up to $2 million with seller financing. And the broker a lot of times may have a queue of business owners that are ready to sell in the near future and may, sort of go off market, if you will, and approach the business owner. Or if nothing else, they may just add you to the Rolodex. And so when those opportunities do come up, they'll be like, hey, here's an easy sell. I know Isaiah's looking for this. Let me give him a call and see if he's still interested. So doing that and just basically building relationships with, brokers in your local community is an easy way. Where you find the best deals, and and granted, this is where the hustle piece comes into play, is really going off market. Just the old fashioned way of pull up a yellow book or phone book and just kind of go through HVAC companies and cold call or send emails or send letters just saying like, hey, I'm in the market to buy an HVAC company. Here's a little bit about me. Here's my contact information. Let me know if you're interested in selling or be willing to at least have a coffee and chat. And then that way you find owners that may not have been quite ready to sell, or even a lot of times, more often than not, owners may not even realize they can sell their business. Mm-hmm. And they're to be willing buyers, because most kind of just think through hey, I was planning on my kids taking this over, and all of a sudden my kids told me hell no. And so they may be going through that, and you happen to catch them at the right time, and they're like, yeah, I'd like to have coffee. And that's where you find some really good deals, because you're not necessarily going through a broker. You're not necessarily going through other channels that could artificially inflate the price, because a broker is going to want to maximize their return. So they're going to basically toe the line between the valuation of the business and what someone will actually pay for it. Whereas if you can find it off market, you can get closer to, quote unquote, the real value, or what the person would be willing to take type thing, where it's a just win-win for both parties. And that's where you can also get more creative financing, because the broker wants to get the deal done quickly. So like an SBA loan or something like that is typically more enticing to them. But yeah, I mean, it really depends. Like, the more desperate you are, I think the more hustle you can put in and get some better deals. But you can also, during a recession, just artificially create some hustle and just go find those opportunities. And if you have those opportunities, they're out there. So it's just more of you either need the time, desire, or money to find them. And if you can do that, you can definitely build some insane generational wealth.
Yeah. What do you think about holding cash or building up and trying to say, okay, should I be investing right now, or should I be holding more cash? Thoughts on that as you think about moving into a recession?
I think it depends on what your path is. So the one we're going into now is a very unique one, because one, inflation's still running rampant, so cash is not necessarily ideal. But I think we still have a long way to go down too for more traditional investments. So I think it really, in these type of opportunities, you have to just sort of take stock and say, okay, what is it I really want to do? Where do I see the biggest opportunities? Like for me, I think having cash ready for a down payment on a small business is worth having cash. I know it's losing to inflation, but even though I'd maybe rather have it in Bitcoin or something different, having not subject to that volatility, when I know if and when that opportunity comes up, I can be ready. That's very enticing. Another opportunity, depending on kind of where you're at with your investments and how much money you're working with, it could make sense to have a very defensive liquid portfolio and use a margin loan as, like, say, a down payment on a business or a rental property opportunity that comes up or things like that. Typically I would say trying to keep cash to a minimum is, in an inflationary environment's ideal. But at the same time, if you're strategic about it and say, hey, I'm going to keep this cash for a max a year, let's say, and I expect, this recession is going to be another year and we're going to maybe see another 20-30% market drop. Okay, well, maybe if that's the case, you say, all right, I'm going to dollar cost average this amount over the next year. And so I'm buying in as the market's going down, because I don't know when it's going to bottom or things like that, but at least I can try and take advantage of this volatility. So again, depends on kind of what your goal is and where your comfort lies with investments. Like if you're only comfortable with liquid investments, then I think dollar cost averaging during a downturn is a really good way to do it. It's one of the only times mathematically dollar cost averaging actually works.
Yep.
But I think that's an interesting opportunity. But again, if you're interested in things like real estate or businesses and you need that down payment, even though cash kind of sucks, it's still kind of better of two options.
For sure.
Yeah. And if you're okay with the volatility, obviously, our fallback of Bitcoin is a good option.
Yeah. I think makes total sense. And having the ability, and I think you talked a little bit about maybe being a little bit more defensive. One thing I think it's always a challenge is you get the question, oh, should I go all to cash with all the investments? And it's like, no, you don't necessarily need to go and make that like all or nothing kind of decision, but you can make tweaks around the edges or make some adjustments. Obviously, the best time to make those tweaks is when times are great and you're up a lot versus being like, oh, I'm going to reevaluate this after I'm down 20, 25, 30, 40%. So like trying to be proactive with those adjustments and changes, certainly very, very important. But thinking about like, what is the goal or what is the role of these funds? What am I trying to accomplish? I think ties into how much cash you want to hold. What else, when you think about a recession, and it doesn't necessarily be like investment related, but how do you think about other things that would be helpful, whether it's ideas, tips, thoughts?
Yeah, I think the biggest things outside of just investments is sort of like from a lifestyle perspective. But because there are so many opportunities and also risks during a recession, I think really understanding the lifestyle you have today, the lifestyle you want to maintain, and matching those investments too, I think is really important. So I typically am not a huge advocate of budgeting just for budgeting's sake. I think if you use it as a tool to like kind of guide decisions, I think that's a great thing. And I think now is a time where having a budget and really understanding where your money is going is super important. I mean, actually, me and my wife just sat down and did this again, like over the weekend, kind of for this exact reason, where we felt like it was lifestyle creep, but it was just sort of inflation and things like that. But yeah, really understanding, hey, where is my money going? Are these the things I value? Is there room for us to cut back for the time being in case there's a job loss, or to build up an emergency fund in case there's a job loss? Or if, on the more optimistic side, there's not a job loss, to prepare for some of these opportunities or to dollar cost average more into the downturn. So I think really looking at budget, cash flow and things, I think is really important. The other is, I think it's a good exercise to really like get morbid and plan for a worst case scenario. Like sit down with your spouse, your significant other, or yourself and just say like, hey, if I lost my job or spouse lost a job or both of us lost a job, what would happen? If it was 6 months, a year, like where would we be? And it's like a painful exercise, but go through it and see, like, it's a kind of the stoic mentality of like, hey, if you actually think through the hard times and prepare for the hard times, well, when the hard times come, it becomes opportunities.
Mm-hmm.
So I think really understanding where your situation breaks and preventing it from breaking, and thinking through every facet, whether it's like, okay, if you lose your job, you lose your healthcare. Well, what's COBRA cost for you? Do you have other healthcare options out there? And what would that cost for you? Like, do you have a disease or disability that would be drastically more expensive under something like COBRA? So really thinking through every facet of that worst case scenario, I think is super important. What are your thoughts?
Yeah, I think all those are great. And I think, similar thought on the budgeting piece as far as it being, something that you just don't need to do all the time, but like reviewing of like, where are we and thinking through that's great. My favorite thing that I always talk about, and we've talked about this online, offline, lots of different times, right, is the idea of food security. And I think that's one with supply chains and things that have been difficult, like trying to say, how can I source as much of the stuff that I get and eat and consume in a, closer proximity to where I'm at versus relying on, big, grocery store chains or different things. So, I mean, my favorite thing is like, hey, look at what's going on with the ability to pre-order the protein, animal protein that you have. So, think about like one initiative I think it's been great that I've followed and has been really cool to see is like this idea of the beef initiative, which is go shake a rancher's hand, order, half cow, quarter cow, whatever, get your protein, store it, get a deep freeze, like have that food security piece solved. I feel like I'm like turning back in time into kind of what people used to do, but like the idea of canning or making your own stuff, like just being more secure from a food perspective. Again, back to the standpoint of like, okay, what are you actually spending? And then can you look at this and say, yeah, it's a big chunk to spend to buy whatever it is. But then I have it on hand and I can cook and make those things here. And if something would happen, like we have a good runway of like good solid food. And I think that is something where a lot of people don't have that built up because everything's been, it's always there, it's always there, it's always there. We've been trained that way, but that could change. And again, that sounds like a doomsday, like terrible situation, but it's like, no, like we can reflect and go back and think not that long ago where there were some issues getting stuff that we wanted. And so just
think toilet paper during COVID.
Exactly. So just plan for it. Worst case scenarios, you eat through that and you probably save some money. You're probably going to improve the quality of the food. And then just, continue to stay physically active, I think is super important, especially if, God forbid, something happens. Like, okay, give yourself ample time to go for a walk, go for different things, think through stuff, sit, and just try to be strategic. So the idea of, looking at debt right now. So if you're carrying credit card debt, carrying these different things, like try to get that addressed now. That way that's compounding on top of job loss and other things. Like if you're paying extra on your mortgage, you're paying extra on these other things, pause that. Maybe just start to accrue a little bit more cash and bump up that emergency fund because those bills will still be there, but you don't need to, sink that money back into your mortgage at the moment because you might not be able to then access it. You might be able to get a HELOC and be able to pull on it and, that'd be a bridge, but it also might be a period where they're like, we're not really extending this at the moment because, you don't have the income at the moment and they won't do that. So that to me is the biggest thing. We talked about side gigs. We talked about, personal expenses, talked a little bit on investing. I would just continue to say whatever you are consistently doing with investing, continue to do it. Don't necessarily stop. Don't make drastic changes. Make tweaks that you need to. And if you feel like, hey, I have way too much risk, make that change because you want to be able to stick with it through because it could get more painful from where we're at. I don't think, to your point, I agree. The true pain has been felt yet.
Yeah.
I don't think there's really like this panic yet from that standpoint. And maybe we don't get there. Maybe everything is fine and dandy and, that's everything works out. Maybe not. So again, that's where the, crystal ball is a little cloudy from that standpoint.
Yeah. And I know we give each other a hard time and also, our team gives us a hard time for being sort of tinfoil doomsdayers, but Isaiah and I actually split a cow that we have in our deep freezers. At least I still have mine, at least a good chunk of mine. But also
I ate a lot of beef.
Yeah, also ordered a lot of flour and things like that. But Isaiah and I have also do things like gardening and like Isaiah, I know cans but the way I look at it is, okay, say there's a worst case scenario. I've learned a valuable skill set like cooking, gardening that I can use for fun. It's like making my own pasta and things like that are still fun things to do. Having your own higher quality beef is still a fun thing to do. So, sort of prepares you for a downside, but also you've learned a valuable skill set too. But something along the credit card lines actually kind of triggered a thought that sort of counterintuitive, but setting up credit cards and things now is actually a interesting protection tool where if you have the income now and let's say you don't have, credit card debt or have very manageable credit card debt, well, doing things like calling up the credit card companies to get a higher balance on your credit card or higher credit availability, or go get your HELOC set up now while you have the income. Mm-hmm. It's, an added version of emergency fund.
Yep. And let's define HELOC real quick for those listening.
Home equity line of credit.
Because I did the same thing. Yeah. And sometimes jargon is it's embedded and we need to get away from that. But yeah, home equity line of credit.
Yeah. So basically it's a line of credit similar to a credit card that uses your house as equity. So if you have equity in your house, I think it's either 20 or 25%. I'm blanking on
it depends probably on the bank, but it's at least 20.
Yeah, at least 20. Some banks are 25. You need at least 25 before they'll set up anything. But yeah, getting a home equity line of credit, let's call it 25,000 to 100,000 or whatever. You don't have to use it. So you don't get interest until you actually take money out of it. Same with credit cards. You can increase your credit card availability, but you don't actually have to use it if you don't need to. And same with like another form of debt that I'm not necessarily a fan of, but I'm a fan of having for using as a tool or for a worst case scenario is if you have a brokerage account, set up a margin. So margin, for those that don't know, is basically similar to a home equity line of credit, but basically you're using your stocks as collateral instead. And you can essentially withdraw up to 70% of the value of your portfolio. Don't necessarily recommend doing
don't
that.
get a margin call. There's nothing worse than the value of the account dropping, you getting a margin call, and you're like, I don't have anything else to put in there. So you want to make sure you give yourself good buffer. So like that loan to value idea is something that you need to really sit with and understand kind of what the risks are. So understand, okay, if I'm 100% stocks, like this could get cut in half. So let's really be strategic with that. And maybe, to your point earlier, that's probably not the right thing going into this to say, hey, I'm going to go take a bunch of margin on all my equity portfolio. Maybe it needs to be, something that's a little bit more defensive, a little bit more of a blend that's not going to have, the 40, 50, 35% drawdowns, something that's a little bit more manageable.
Yeah. And ideally you don't have to use this or necessarily even want to use it potentially, but it's a way to I think a better way than selling your stocks for cash when things are down. Because you don't necessarily know when you're going to be able to reinvest cash to participate in the upside. So by taking a margin loan instead of selling, you're basically preventing from having to liquidate stocks at their worst possible time.
Yep.
But again, any of these debt resources you want to kind of use as a means of last resort. But if you can get to where you have $200,000-$300,000 worth of credit available, that can get you through, especially if you're tight with your budget and things, that can get you through a very long time of hard times.
Yep.
So I think that's something that's definitely worth doing now when you have the income and things and banks are willing to give you the extra credit, than waiting for a job loss and then trying to go retroactively get the stuff when it's going to be much harder.
Yeah. And last thing to kind of think through as well is, we talked about at the beginning, like, hey, we think we're in a recession or whatever the definition of a recession is. One really good indicator is something that when you look at it is the yield curves, which is basically just like government debt and then different terms. So like a 1 year, 2 year, 10 year, whatever. That's been a really good, reliable indicator. And at the moment, there's this inversion. So you might hear yield curve inversion. Like that has been a really reliable indicator that we're either in a recession or things are slowing down and like this isn't good. It's not natural. Because if I loan you money, Josh, and it's for 10 years or 2 years, I would expect if I give you money for 10 years, I'm going to make more. You're going to pay me more from an interest rate than 2 years. Well, right now that's flipped. That's unnatural. It's not normal. And so when that happens, that's usually a trigger of, ooh, weird things are going on. Very technical term right there. Weird things going on. And that recession or a slowdown is likely on the horizon. And there's been a lot of good studies and information done. Cam Harvey, who I think he's a Duke professor, PhD, and he also does some work for research affiliates. He's published stuff on this a long time ago, and it's been a really reliable indicator. So we're there right now. And so like, just to give you an idea, that is certainly one of those things that tells us like, hey, it maybe is a caution light out there, and which is why I think this topic is important. And then you look at the University of Michigan does a consumer sentiment study and index, and that's the lowest level it's been since like the 1980s, where people are feeling the pinch. And the average person out there, when you have energy and food, energy up 30% year over year and food up, in the teens, that's going to, weigh on their disposable income, and they're going to feel like things are rough too. So that is going to be self-fulfilling at some point, unless there's a massive change. So that's why we feel like, hey, this recession thing, we're there, but it could continue to kind of perpetuate and accelerate a little bit. So it's not just, pulling something out and saying, hey, we think this may, like it, there's some merit to why the discussion is happening right now. Yeah,
for sure. And it's definitely something that you should be preparing yourself for, ready or not, because here it comes. We're already seeing like Amazon actually laid off 100,000 employees in Q2. So it's here, whether we want it to be or not. And so I think it's just, to your point, we control what you can control is basically, what happens in the global economy and the world economy
100%.
And your own job. Like you can't control. You can't control setting up things like credit card debt, going through your budget, deciding where you want to invest and what the opportunities are for you. And you can, decide to, create a side hustle and, take a look at what your skill sets are and where you can, upload to Fiverr or whatever. Just look for opportunities to make money Like, start doing those things today. Those are the things you can control. And really, that's all you can do.
Yep. I think that's a great spot to kind of close. And, always appreciate you all for tuning in. So again, like, subscribe, do all the things that we tell you in the outro to do. Share this with a friend. I think that's the biggest compliment, right? So want to get content out. And then feel free to reach out to both Josh and I through social media. If you have a topic that you want to hear more on or have questions, we'll probably start doing kind of Q&A questions as this podcast grows, where we'll just start collecting that information. So send it in and we'll kind of queue those things up. But thank you so much for tuning in.
Yep. Cheers.
Cheers.
Thanks for listening to today's show. The comments made on the show should not be taken as investment, tax, or legal advice. All comments are for educational purposes only, and you should talk to your professional team before implementing any of these strategies. Josh Bennett and Isaiah Douglass are partners at Vincere Wealth Management. Vincere Wealth is a registered investment advisor with the U.S. Securities and Exchange Commission. The biggest compliment you can give us is to share this content with your friends and family. Reviews help our show to get found, and Apple Podcasts is the platform that is predominantly how people listen to this show. If you have 3 minutes and you love the show, head over to Apple Podcasts and give us an honest review and rating. We'd greatly appreciate it, and that will help people find this show. Also hit subscribe on the YouTube channel so that way you don't miss any of these episodes. For all today's links and information, head over to the happyhourmoneypodcast.com. Thanks for listening, and we'll be talking to you again here soon.